Hello, everybody. This is Richard C. Wilson, the Family Office Club and commercialrealestate.com. And today we're going to go through 20 question and answers with Peter von der Hey, who is an expert on multifamily and triple net real estate. Welcome, Peter.
Hey, thanks, Richard. Looking forward to having this conversation.
Sure. So we've gotten to know each other over the past couple of years, and I know that you have, completed over $1 billion a year of commercial real estate deals over the last, several years in a row. And the point of this interview will be really to knock out a lot of questions we get related to triple net and multifamily properties. This will be a good video for someone who is really looking to maybe invest in triple net, but they really don't even know the basics of it, or people that have a lot of questions about it because they've heard it's tax efficient or they've heard it could be better than investing in other types of retail assets or office parks, et cetera. So I appreciate you doing this. So to begin with, what is triple net real estate?
Well, net leased properties are essentially, it's any type of investment real estate where the tenant has basically entered into a lease with the owner of the real estate itself. And in that lease, it says they are going to pay you rent and operate the property. And as far as the economics of the cash flows go, your operations are net of any real estate tax expense, insurance expense, or any operating costs. And in the true pure triple net definition, that would include any maintenance or operating of the property.
Okay.
When you get into these properties, though, there's a lot of nuance and all those nuances are actually explained and need to be further researched in the lease, because when you get into this, there's triple net, there's double net, there's and everything in between, and there's a whole lot of kind of slang terms that people use in the industry, sometimes correctly and sometimes incorrectly. So if you start with the purist, this is a piece of real estate that is leased to a tenant that takes care of all the operations and all the expenses, and all you get is one net net rental check. And then there's everything in between. Right.
Okay. Makes sense. And if you're talking about how it differs, if someone says triple net versus double net, is that usually the taxes that are left in? Is that usually the difference, like in shorthand when people are talking about it, or can it mean all different types of things?
It can mean all different types of things. Generally, what we'll see is that the biggest difference will involve some type of capital items. So meaning that the tenant will be responsible for most of the maintenance. However, if something happens to the roof or something happens to the structure, there may be some type of calculation that determines the economics of when the owner would have to step in and contribute to the remedy of that. A lot of the times that this comes in, and where you have to look at the language, is toward the end of the lease term, because off the rack, many of these properties have 20-year leases, but then in the lease clauses themselves, some of the details that we're talking about relative to the economics and who's responsible for what, that may change in years 18, 19, and 20. And so those are just little details that you need to explore as you enter into this investment type. Sure.
Okay, great. And are there any tax advantages to investing in triple net real estate versus other types?
In general, one of the, I think there are 3 or 4 major tax advantages for investing directly in commercial real estate itself. And just quickly, one is the 1031 exchange. The other is the, being able to use depreciation. The other is being able to write off your interest expense when you get a loan. And as far as the, the special tax characteristics, some types of real estate qualify for bonus and accelerated depreciation, which allow you to shelter more cash flow. And if you have cash flow from other investment real estate, it may carry over and shelter that cash flow as well. So we see this most mostly when you're selecting certain types of assets that have accelerated depreciation. And then if you combine them with something called a cost segregation study, that's where you get a real pop in terms of the depreciation benefits.
Sure. Okay. You've seen hundreds of triple net properties. So what valuation best practices can you share on triple net commercial real estate?
The valuation best practices, there are so many. There are a couple different factors. I mean, you've got the tenant, you've got the location, you have the credit of the tenant, and then you have what we would call the unit economics, which are how is the actual economic performance at that location, and then finally the cap rate and the financial metrics that you're actually purchasing the property at, and what the lease term is, what the increases are, and how those are calculated, and all that kind of stuff. So those are all there's about those are the 4 or 5 main dials that you would use to evaluate any net leased investment. And most of the time, what you'll see is that not all 4 will rate a 10 out of 10. And it's up to the individual investor themselves to figure out what they're comfortable with. And to just make an extreme example, some people may be comfortable with a very poor location, but a very, very high quality tenant, where the asset or the business in that location is performing very well, and you get a better cap rate, as opposed to you could be in the middle of a metropolitan, some type of the middle of a city on a main location where the location is out of sight, but that's going to be priced very high. And in that case, because you've got all the demand drivers, you may be less concerned about the credit of the tenant. And that becomes a very personal decision in terms of what your objectives are. So if you're, the way we get into this, and the way I really entered into this type of advisory part of the business, is you have a couple demographic shifts happening in the country where you have massive amounts of real estate owners who have held management intensive real estate for 10, 20, 30, 40, sometimes generations of years. And they get to a point in their life where I heard one say the phrase to me that it's nice to own a lot of real estate, but I almost feel like the real estate owns me. And so one of the motivations for investing in this type of asset class is to begin to lessen your management load, take advantage of the 1031 exchange tax deferral, and in many cases, your cash flow increases. So the combo of those two things is a very nice solution for people. And not to mention the diversification, and there's a whole other, that's a whole other category that we could talk about for an hour. And, we're talking about this, we're having this conversation in coronavirus time. And, if every investor in every asset class hasn't learned the benefits of diversification, you really got a lesson in it now, depending on how, all of your investments have been performing over the past, 6 or 8 months.
Right. So if I'm understanding right, it's almost like it allows you to be a little bit more passive of an investor with triple net versus if you own an office park or a multifamily property, right?
Yeah, that's exactly part of it. And that's one of the main drivers, is that there's less day-to-day execution risk. If you had to be very, kind of like the negative stereotype is, this is, this asset class, you're just buying a bond and they're bad investments. But when you get into the, just like anything, as you learn more about it and you explore the asset class further, there's a whole bunch of triggers and ways to add value that are all dependent on how you structure things, and kind of, how the location develops, what's happening with the tenant, how the increases are the rental increases are structured. And a lot of it has to do with your financing and the lease terms. So I would say that there is in these type of assets, there's less day-to-day management, obviously, but that doesn't mean that it's completely devoid of any type of strategy.
Right. Yeah, makes sense. And why is it that triple net commercial properties are often nationally traded versus more locally or regionally traded?
Probably the single biggest driver for certain investors with these is the credit of the tenant. So if you have a national publicly traded company that is standing behind the lease, your rental payments are not dependent on the performance of the one location that you're buying. Your rental payments are guaranteed by a company. And in this example that we're talking about, in theory, you're backed by a company that has many locations across the country. So that's worth something. If you are entering into a retirement phase of your life where you want to have less day-to-day management, your main drivers are, I want income security and I want consistency, and I actually don't want surprises either on the positive or the negative. It's actually more important to you to just have a steady stream of cash flow. So that's why you see many of the brands that are fall into the triple net category that are national.
Right.
When you get into this, I'll just add this is also another area of this asset type where you have to look at the lease, because you have to look at who's actually standing behind the credit. Sometimes there are franchisees that may be a national brand, but you may not be getting national credit, and so on and so forth. So you have to work with experts who really know that space, and part of the assembling of your investment team, which is accountants who know about this, attorneys who specialize in this, and then also from the investment world, brokers and what have you.
Sure, makes sense. So based on your experience, what are a couple of strategies that an experienced triple net investor would take? You kind of hinted earlier about how maybe going after very high credit, but maybe what would be considered a bad location might get you a better cap rate, and your downside is really limited by the fact that it's based on the credit of this firm, as long as it's not by a local franchisee. That sounds like one strategy an investor could keep in mind. Is there another strategy or two related to this area that could be helpful to investors listening?
Yeah, and I guess I would put the first thing out there that's kind of a mindset that I think a lot of it that I see investors go through is a lot of investors show up initially and they think all their money has to be treated the same, which means I've got to maximize every single dollar I have. And if you step back a little bit and, not to get philosophical, but if you think about what's the value of money, or what purpose does money serve in your life, a lot of times it's to give you freedom. It's to give you some type of security. And if you start the conversation there, not every dollar in your portfolio has to be treated the same way. So I think it's completely appropriate to look at some dollars and say, okay, this money should be treated to give me security, or cover certain things. And so that may impact how you approach what's available in the net lease market. Another strategy that we'll see that can be a little more entrepreneurial is, as I said before, a lot of these investments come out of the gate with 20-year leases. When you begin to cross the threshold where there's 10 years remaining on the lease, and knowing most banks will give you 10-year mortgages, when you have fewer than 10 years left on the lease, that would be the time period when the value would be impaired, in theory, meaning that even though that tenant could be doing gangbusters business and it could have great credit, you are introducing the lease expiration into that conversation that may have 7 years left or 3 years left. And so that's uncertainty. And so whoever's buying that property from you will want to be paid for that type of uncertainty. And the bank will want to make sure that they're protected from that uncertainty. So the loan dollars may be lower, the buyer pool may be smaller. On the other hand, if you want to be more entrepreneurial, that's where some buyers will look at those properties where the lease expirations, where you have fewer years left on the lease, because that may be an opportunity to pick up something at a better cap rate if you're willing to do the market research, or you're comfortable with the risk that you could either the tenant's going to renew, or you could re-tenant it, or some other option. So that's one of the areas where the business can become more entrepreneurial.
Right. Makes sense. Okay. Who is a typical triple net investor? Are these mostly institutional investors, or is it a whole bunch of retirees and the institutions stay away? Or
Yeah, that's one of the misnomers of the industry. About 75% of the industry is actually run by institutions. It's in the billions and billions of dollars. You have publicly traded REITs, large private equity firms. So most of the net lease market is actually controlled by institutions. It's about 25% that's private individuals.
okay, great. And what do you think the future of the net lease commercial real estate market really looks like?
Uh, I, I I think if just from a demographic standpoint, you have the baby boomers who are continually to run through the demographic cycle, and that bodes very well for this asset type. I think as you see the economy diversify, everything that's happened over the past 6 months, and you've seen what's happened with supply chains, warehousing with Amazon, and all that type of kind of last mile stuff. So uh, you're seeing whole categories of real estate change in terms of how they're used, and companies' uses of them. And I think that's going to expand. The real marriage with net lease is that you have private investors who want to own the real estate. You have companies who want complete control over their real estate, but they don't want to own it. If they have an operating business, they're most likely making 20-30% margins, or they should, hopefully they are, right, in their operating business. They don't want their money tied up in real estate that maybe appreciates 3% a year or whatever, right? So it's a perfect marriage between investors who want to own real estate but don't necessarily want to operate it, and companies that want to operate their real estate but they don't necessarily want to own it. So I see this trend continuing because it's good for companies, and also just the demographics of the investor pool in the country, as people shift from management intensive real estate to this type of real estate.
Right. It's interesting how seldom net lease real estate investments come up compared to multifamily self-storage within the private investor space. So I appreciate you bringing all of that up. In terms of the future of net lease properties, on how they're identified, valued, traded, invested in, do you see technology drastically changing this area, or pretty much same as all the other areas of commercial real estate? People are using technology more now in deal sourcing and connecting with each other. Is there any unique trend you're seeing with net lease properties that makes it different than other niches that way?
Yeah, I don't know that I would say it's particular to net lease, but in the entire real estate industry, real estate, as far as all the industries, probably is one of the laggards in terms of technology. But technology is bringing a lot of more transparency. It's bringing efficiency. It's crazy if you compare like what Airbnb did to the hotel industry. If you wanted to get or if you want to, or a lot of the travel sites, for example, if you want to find out what hotels are available in Los Angeles, for example, you can do that from your desktop anywhere in the country. If you wanted to find out all the triple nets that were available in some city, or any piece of real estate for that matter, we still don't have an aggregated technological site or company that has figured that out. And there are several different reasons for that, but it's heading in that direction. So that transparency, I think, you were asking about the long-term implications, and we could go into crowdfunding and some other things, but as the information is more democratized, as the access and opportunities to invest in these asset classes are democratized, in theory, that should bring cap rates down, because you're expanding the buyer pool, you're making it more transparent, and you're making it more easily accessible.
Okay, great.
So it's exciting.
Well, yeah, for sure. And there's some big changes coming. So what would be a way to add value and boost the valuation on a net lease or triple net property? You mentioned earlier maybe extending the lease term so it's not impaired if there's less than 10 years. I would guess that would be one way. Is there another way or two to add value and kind of boost NOI or boost the return for an investor?
Yeah. So the cash flows are set. That's a lease. It's determined. It's predetermined. And so all the value creation here is not really going to be something that you're going to do like another piece of real estate where you can offer something else to the tenant or something like that and they'll pay more, although maybe that would occur. But um, a lot of it has to do with the transition points in the lease and the ownership period, and it has to do with financing. So as many leases, for example, they have increases that occur. The rent jumps after 5 years or every 5 years. Well, when that occurs, there is a, obviously the rent's jumping, the value is going to jump. And so depending on what your entry point was on that piece of real estate and what your financing is, you may have a little bit of cap rate compression and your rent went up. So there are certain periods where if they're timed correctly, that may be, transition periods where you can actually make a profit. Sometimes we'll see with some of the bigger properties that have a lot of land, that there may be a collaboration between you and the tenant to parcel off some of the land, and you can use that with another tenant, and therefore the company gets a cash infusion and you can add some value. Those are not run of the mill, but there are kind of unique situations that I would put out there that you could look at. So, I would categorize that in just being creative with real estate, just a creative real estate professional. Sure. And then as we discussed, as you get toward the end of the lease term, if the tenant's doing very well, they're not going to want to leave. They're going to want to extend. And probably the biggest misnomer in the industry is outsiders really discount the value of having the lease with a credit tenant and having that already done and cash flowing and operating, and how valuable that is. So, for example, if you had 2 years left on a lease and they were going to extend the lease and the rent was going to go up by 5% or 10%, at that 2-year point, yes, your rent may go up by 5 or 10% in a couple of years, but there may be additional value for you at that moment to extend the lease by 10 or 15 years and not raise the rent as much if you had a good credit, because now a new investor can come in and buy that asset knowing they have a new 10 or 15 years left on the lease instead of 2, and there would be value creation there. So, so you kind of play that by ear.
Okay. And if someone wanted to compare a apartment building investment versus a net lease investment, I guess one is very active, one is more passive. I guess in an apartment building, you might be able to boost an OI by adding revenue in a few ways, or do better property management, and your income is going to fluctuate month to month, quarter to quarter. I guess when an investor is looking at where to allocate to, you talked about diversification earlier in this interview series. So would you say that when an investor is looking at these two types, it's not really which one's better, it's just they're very different, in that if you do want diversification, it might be good to consider both, or what would be like a major negative trade-off of one versus the other, maybe if an investor is looking at that option?
Yeah, well, I think they're completely different investments, but I think the drivers for the investors themselves are very similar, because one of the benefits of investing in multifamily is you have 100-unit property, you have 100 different rental streams. So if you have a problem with 2 or 3 of them, the investment's still going to perform fine. It's most likely going to continue to cash flow, and that's a problem you can solve and move on. So, I would say one of the number one reasons why people like multifamily is because of the risk dynamics. Are people need to live somewhere. It's not going to get evaporated by Amazon, and your income is diversified amongst many tenants. So that is, so you're looking for income and you're looking for security of income. Those are the same things that people who invest in triple net triple net properties are also looking for. So they marry together, and it's just it's the same concepts. It's just different words. And now you're talking about the credit of the tenant, and you're talking about how is the lease structured and what are the economics of the lease.
Sure. Okay. You see hundreds of multifamily properties every quarter, I know. What are some of the most important things to look for when inspecting a multifamily property?
I think the biggest thing that comes up as far as multifamily is, obviously all the physical condition aspects. Um, I guess you would say in that industry that these are assets where people live, so they're living, breathing things. Things have to be, they break, they have to get repaired. That's part of the business. What you want to try to prevent is repairs that come up as big surprises, and most of the big ones are well known, and you can research ahead of time. So and in this conversation where we're comparing against net lease, the probably the bigger risk with multifamily is your operations and your execution team. And operating multifamily is definitely a team sport. Depending on how big it is, you have third-party management, you have asset management, you have all of the vendors and the soft skills. So, there are so many different types of players that you have to interact with, from vendors to bankers to attorneys to the tenants themselves and your residents who are actually your customers. So, there's a lot more flavors in terms of that you have to be able to handle and manage. And so things can go wrong in all of those categories, but also things can go very well. And so that's it's the two sides of the coin: the opportunity and the obstacles, right?
Sure, sure.
Mm-hmm.
What about out of all the properties you've seen in multifamily and commercial real estate, what is some common mistakes in the valuation process? And that could be a mistake that could be costly to an investor, or perhaps the valuation was a little bit low and it's an opportunity for an investor because someone made a mistake in valuing, what the property truly was worth. What are some of the mistakes you see there?
I'd say that when you talk about the value add properties, the two biggest mistakes that I see most commonly made is people overestimate what they can achieve in rents after they do their value add work. So we've all seen financial models, and the fact of the matter is that if you make a small increase in your assumptions in year 1 or 2 and carry them out 10 years, a small increase can make a really big difference 10 years later. And if you overshot your expectations or your assumptions early on, it can really change the nature of things. So you want to just make sure that your assumptions that you're making in terms of a value add are backed up, that you really know what you're talking about. And if you're talking about being able to raise the rents, that you can prove generally through some type of comp or at the property themselves that you're actually able to achieve that rent. The other is, typically you underestimate the cost that it takes to get the units or the property up to that level. So it's budgeting and assumptions.
Sure, that's great. Yeah, no, a lot of people, they always have these amazing predictions and graphs of how things are going to go, right? It's never a prediction that it's going to be bumpy,
Right.
in my experience. What's the number one way to drive revenue up on a apartment building investment?
I would say, right now, it obviously, this varies significantly depending on what class of property you are in and what renter you're trying to attract. So first of all, really knowing who your customer is. There are certain customers now that if you're making your units tech enabled and putting in, Nest or all types of, virtual concierge and stuff like that, that the tenants are looking at those type of amenities, and they're appreciating them, and they'll pay up for them. Other ones, it's very simple upgrades to the unit that are less costly, but that will separate yourself from the competition. So, and that could be, stuff with flooring, molding, a lot of the typical upgrades. In general, the more care you have in the industry and the more thoughtful you are with how you're creating an environment for your tenants, this is people's home. And if you think about what we've all experienced, this year, it's their home, it's their school, it's their gym, it's their restaurant, it's their movie theater, it's all these other things. So that's probably the biggest thing that's coming through in all property types, in all locations, is that the reputation that the ownership has with their tenants in terms of, are they really going out of their way to try to make it the best living experience? That's coming through in collections, renewals, tenant relations, and property performance. So there's not one answer to that category because it's a soft skill, but we're really seeing those who do that aspect of the business, those that do that well, they're reaping the benefits of it right now.
Right. Great. Yeah, no, it makes sense. It makes sense. It would be especially emphasized during the pandemic when
Right.
people, even if you're only somewhat locked at home, you just can't go out to eat as much. You can't, go to the movies as much, like you said. So even if you're one that's a little bit more bold and not really, you hate masks and you want to go out and live your normal life, your normal life is still less normal, in these times at least. So that's great. Just two more quick questions. What was key in your past in doing $1 billion plus a year in commercial real estate brokerage transactions year after year? What was key in that, in case there's a broker listening or someone who's just getting into brokerage right now?
I would say in a word, it would be just being a good listener. So because it's in the listening and in, implicit, if you're a good listener, you're less transactional. So people can really feel if all you're trying to do is to make money as quickly as you can with someone. But if you play the long game and take a long-term approach, it may be a little slower in the beginning, but if you have your value, your stuff, that will definitely pay off over the long term. And that builds. And then as you incorporate technology into your process and incorporate teamwork, and you're thoughtful about your teamwork, which all clients expect right now, the technology, the teamwork, and the combination, and being long-term focused. If you do that well, and then make sure that your specific knowledge that you are being sought after for, if you have that all as a winning combination and they're all improving each year, you'll do very well.
Great. Yeah, appreciate you bringing that up. My last question here is, how could someone first get started as a commercial real estate broker? Like, what's the first step or two they should take so they have a good foundation in the industry?
Without a doubt, if you're new, you want to associate with someone who's not new. And that can look at different forms. And a lot of times, whatever market you're in, you may have 2 or 3 choices in terms of your entry point. You got to pick the best one. And it may be someone who's got 5 years more experience than you, and it's a very small partnership. Or it may be, like in our situation where, there's a team and an organization that has almost 20 years of experience. And there's a whole structure that can give you a very diversified support system and also knowledge base to tap into. So, I can't think of the phrase right now, but there's like hundreds of these of how much time you save and how much more money you make by, you don't have to reinvent the wheel the first time. And each time you do something. And so that's probably the most common mistake. Someone who is getting into the real estate brokerage industry, they're very, they're driven, they want to do it themselves. And those instincts are very, very good, but you want to put the teamwork in there, because a good team member can save you years and years and years and help you leapfrog. So, that would be my biggest advice is to, really research and at first, research a good person to associate with. And at first, it's not about the money. When you are entering, it's not about the money. It's about what you're learning. Right.
So being more medium, long-term focused on learning and being mentored by someone who's a true veteran expert, not, where do I get a 64% versus 79% split, just flipping that mindset.
100%. I mean, it was very common for me to see the first 10 or 15 years. I have several stories I could mention of people I would watch enter the industry, and they would, kind of by luck, do one big deal. And then they would go through 2 or 3 years and not do any deals, and then maybe do one big deal. And you would say, okay, well, in that 3-year period, maybe averaged out, they did pretty well. But if you come back to them 7 years later, compared to someone who during that same time did 40 or 50 deals, now they have hundreds of clients, and not to mention all the additional client relationships that they've made during those times. Their income, their contact base, their knowledge base, it's much more diversified. It's much more robust. So, just like anything, it's really about playing the long game and not trying to shortcut.
Right. Yeah, that seems important in every part of business or investing. So
right.
Appreciate your time here today, Peter, and thanks for being a CRE power player on commercialrealestate.com. I appreciate all the advice and insights and taking your time out of the day to do this interview here.
Absolutely, Richard. Thanks a lot. It was a lot of fun.
Yeah. Thank you.